Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Senior Portfolio Manager. Thank you so much for giving us some of your time this week. We've got two main topics, but with one of them's got several different pieces that Andrew will unpack in the 493 versus 7 stocks. A lot of good stuff in that. And then we'll also talk about tariffs and trade deficit. Certainly a big noisy week on that front last week. And so I'll start with that. Just a couple of points before I go into the data and the charts. All right, so again, a noisy week. I'm sure most of you heard about the Supreme Court striking down the foundation of which the administration had implemented its tariffs last year. And so we're really going to be moving to a period where we have a more of a permanent and punitive tariff structure to one that is more trimmed back and temporary. The ones that are going into place initially at 10% and then proposed to go up to 15% soon. Those are going to be more on a rolling time frame. So we're reintroducing a little bit more uncertainty in the trade space. So we don't really have much in the way of answers. Nobody really does how this is going to play out over time, or whether Congress gets in, which is really where the long-term and permanent tariff authority rests. So that is certainly one possible caveat. And then the last wrinkle in this is the refunds of the tariff revenue that was collected last year. That is likely to be a political football that is passed around probably way more than months. I think we're talking about years in terms of who and when or if there are refunds for the tariffs that were collected last year. But either way, we are shifting. But if we just take a step back and we pause and we look at last year, one of the stated goals, the primary goal of the administration of the tariffs, was to reduce the trade deficit, which is the chart that we're looking at here, year by year, going back over decades. So this is a chart of what the rest of the world buys from the U.S. minus what we buy from them. And so that has been a growing and swelling negative number as we buy more from the rest of the world than they buy from us. And last year was the year of tariffs following Liberation Day in April. And even though we had those more broad, sweeping, and higher tariffs than what we're going to see going forward, most likely, there was really barely a dent in the trade deficit. And this is also beside the fact that the dollar came down. When the dollar comes down in value, our exports become more valuable, and on the margins lead to a trade deficit that comes in. But I really want to give you some more meat and some more thoughts around this context, because it can be confusing, and on the surface it can be look like a damaging or a bad thing. But I want to paint the picture why this is not necessarily a bad thing. Number one, part of the reason why this is such a hard trend to curtail and why we didn't see it narrow is when the U.S. is growing faster than the rest of the world, our prosperity leads to consumption and inertia that it rests within our trade balance. Leads us to, again, consumption trends that are positive. And the other thing I would state is that this is the trade deficit, and it always has a mirror image brother, and that is the capital account. And so if the trade deficit is negative, and I know we're really getting into the nuts and bolts of economic detail here, but it's really important. If we're buying more goods and services from the rest of the world than they're buying from us, that leaves them with a surplus of dollars that they then invest back in the U.S. So when we're at a trade deficit in the current account here, we have a capital account surplus. So even though last year was thought to be the year that foreign investors would walk away from the U.S., the opposite happened. We would continue to be a place where foreign investors want to invest their dollars. So not all a negative thing, and there's likely to be noise around this for years to come. And as always, I just mentioned slightly about the dollar. That is really the bazooka. That is really the big weapon that can move this beast one way up or one way down. So if we were to continue to see the dollar come down in value and trend back towards the lower end of its multi-decade trading range, or you would likely see this trade deficit come back in. So that's enough of the econ side for now. I'm going to pass it over to Andrew to get to the 493 and 7.
All right, thank you, Adam. So I have a lot to unpack here. We start the year, we're just finishing up February. We're 2 months into a new trading year, and the market is pretty much doing nothing. Right now, with the little bit of wiggles we've had, the S&P's up a little less than 1% right now. But what's interesting about that is when we look beyond just the index, we're seeing actually a lot of stocks are seeing really massive moves. One of the a very large disparity in performance. So looking again just at the S&P 500, and this isn't the chart that's on your screen just yet, but I'm just going to share some information. Right now, we have over 120 stocks are up or down 20%. Meanwhile, we have about 100 that are only up or down 5%, a massive, massive disparity of the stock performance. When we look at what the actual index is doing, again, it's only up less than 1%. And a big reason for that is for this first chart that I have on your screen. We talked about this a lot in the Market Carver over really the last 2 years, is the massive weighting towards the largest stocks in the world. So on this chart goes all the way back to the 1920s, 1930s, and shows, if you look at that gray line, the weight of the top 10 stocks. It's gotten massive. Almost 39% of the S&P 500 is in just those 10 names, and it's one of the largest stock relative to the 75th percentile. What that means is when you look at this top stock, how is it related to kind of the average? And again, we're seeing massive levels hit there. It just shows how much importance, how much weight it carries for how those 10 stocks are performing. And so when we look since about the end of October in 2025, we've seen a lot of those big stocks begin to pull back, seeing double-digit declines. Meanwhile, we actually are seeing a lot of the other stocks, the other 400, when we look at just the Mag 7, the other 493 are actually doing fairly well. And that's what we're going to look at on this next chart, kind of the bifurcation of this market. So we have the S&P 500 on that top panel. The bottom panel is those Mag 7 stocks. Think NVIDIA, Apple, Microsoft, Google, kind of an equal weighting of all those, making their own custom little index there. In the middle is our advanced decline line, a little bit more of a nuanced tool there. Basically, all we're looking at there is how many stocks are going up versus going down over the last 90 days. Ideally, we see this number move higher. That tells us we have more of the S&P 500 that are advancing than declining, and that's what's been happening here recently. You can look since about the end of October, that line has started to increase as we started seeing more and more stocks improve. Now, why wasn't the S&P 500 rising a lot during that time? We see a lot of stocks moving higher. Andrew, whenever you talk about breadth, you want to see strong participation. Isn't that what this is? And that's exactly what this is. But we can't forget about those 10 other stocks. While we see that green line in the middle go higher, what's that line on the bottom doing? It's actually been going lower. So we are seeing a broadening out of a lot of other stocks going higher. Those Mag 7 stocks, those 10 largest stocks, however you want to break them up, they're acting kind of like a weight on the neck of the S&P 500, keeping it from really reflecting the strength we're seeing elsewhere. Another way to look at this is it's kind of a cartoon I created on the next chart, and it's this tug of war between essentially everyone else, the other 99% of the market versus the mega cap 7. Just those 7 stocks are pulling and counteracting what we're seeing the rest of the market do. What this means is it creates opportunities for investors. It gives opportunities to find those stocks that maybe are performing well and tilt portfolios that way. But it does, again, we can never forget that because there's such a massive weighting, one of the largest really in market history, that whatever those 10 do is going to drive primarily what the index is doing. And that can have implications on impacting other stocks. And it's a whole conversation to be had. But it's a really interesting market that we have right now, to where we are seeing participation improve. A lot of the stocks are moving higher, but the index is stuck because we're seeing those Mag 7s, that massive plow horse is pulling it lower and counteracting some of the good things we're seeing in other corners of the market.
All right. Andrew Thrasher, Chartered Mechatechnician, Senior Portfolio Manager, and in-house Michelangelo. Well done. So yeah, thank you for that, and thank you to all of you for your time. If we can be of service, please don't hesitate to reach out 800-928-4001 or scan the QR code and do it electronically. Thanks, and have a great weekend.